the fact that gold has held up this well in the face of some big headwinds, and these are headwinds that really shouldn't be there, but it's about perception. And the perception was that rate hikes were going to be very bearish for gold, that rising real interest rates, to the extent that they were real, but the markets believe that should have been bearish for gold.
Gain insights into the future of gold prices with Peter Schiff, exploring the nexus between inflation fears and unprecedented highs, as he intricately deciphers the intricate dance between economic shifts and the gilded response. So, don't go anywhere and watch till the end of this important video.
I've been very bullish on gold for many, many years, and so with all the years of gold failing to live up to its potential, nothing really surprises me anymore with gold. I did expect the price of gold to move higher, and it has moved higher. I just would have expected it to move even higher than it did. And the gold price keeps disappointing to the upside. So, I mean, directionally, yes, gold has been going up. I mean, gold is $2,030, $2,040 an ounce. Not too far off an all-time record high that we set about a month ago. I think we got to 2,135. So gold's been going up. And when I first started speaking publicly about gold on national television, the first time I went on CNBC, gold was, 400 and change. So, yeah, I mean, it's gone up, but I would have thought it would have been higher. And I still think I'm going to be proven right on, how much gold goes up. It's just taking a lot longer to get there. But I think at some point, we're going to make up for a lot of lost ground. I think we're going to see a year where the price of gold moves up, several fold. Whether that's going to be 2024 or 2025 or 2026, nobody knows. But I think it's coming. Well, there's a lot of fundamental misunderstandings about gold. But yeah, when gold hit that new record high, rather than just continuing to rise, we had a sharp drop. I mean, gold got to 2135, and the next day it was back below 2,000, or 2 days later. I think it got down to 19, maybe 75. So it had $150, $160 pullback almost immediately. But it quickly recovered. It didn't, go too far below 2,000, and it didn't stay there that long. So, I think that this is now the new support for gold, just around $2,000 an ounce. And that used to be the record high. So the fact that we've now are building support near what used to be massive resistance is a very bullish technical factor. And the fact that gold has held up this well in the face of some big headwinds, and these are headwinds that really shouldn't be there, but it's about perception. And the perception was that rate hikes were going to be very bearish for gold, that rising real interest rates, to the extent that they were real, but the markets believe that should have been bearish for gold. But we've now basically finished the tightening cycle, and gold is still at 2,000. So if gold did this well in an environment of rising rates, imagine how much better it's going to do when rates are falling. And the real environment that I think gold is going to flourish in is when inflation is accelerating, but the Fed is not matching that with rate hikes. And that's going to be a big wake-up call for investors, because I think what was, kind of keeping a lid on gold was the belief that the government, the Fed, was going to be vigilant and do whatever it takes to put that inflation genie back in the bottle and bring the rate back down to 2% and keep it there. And that's just a fantasy. That's not going to happen. And the markets haven't come to terms with that. And so in the past, or recent year or so, when worse than expected inflation news would come out, that would be bad for gold, even though it's good for gold because gold's an inflation hedge. And so if inflation is a bigger problem, there should be more demand for a hedge. But the way the markets reacted to the stronger than expected inflation data was just the belief that, okay, this means the Fed's going to have to fight harder to get rid of the inflation. That just means higher for longer. And that would hurt gold and it would help the dollar. But I think as investors start to realize that higher inflation numbers don't mean the Fed has to fight harder to win. It means the Fed has already lost and inflation has won, because there's a limit to how hard the Fed can fight given how much debt is in the system, especially how much debt the governments have and how much debt the banks are holding. And as much as the Fed would like to see lower inflation, they don't want to see a financial crisis. They don't want to force the U.S. government to default on its obligations. The Fed is very political. And so when it has to pick its poison, it would rather pick inflation than, a financial crisis and, just a collapse of the banking system and a sovereign debt crisis. So when the markets realize that that's where we're going, I think gold's going to be off to the races. Well, first of all, in 2001, the price of gold was under $300 an ounce. And in a 10-year period to 2011, it went up to $1,900. So why didn't the manipulation stop that? How did gold go up so much if there was, people manipulating it? Obviously, it had a big move. Now, it should be even higher now, but that doesn't mean it's because of manipulation that is where it is. But I do think that there's a lot of incentives, obviously, to keep the price of gold down. But there's a lot of big money that is selling gold. When gold hit a new high, there's a trading adage. It's not rocket science. Buy low and sell high. And, people took profits or took an opportunity to short. I think there is a lot of hot money that trades gold futures. And, when gold couldn't sustain the breakout, some selling came in. But we're going to exhaust this selling. I think that part of what's happening here in this bull market is that weaker players are being shaken out of the market. They're being discouraged by some of those sell-offs, and that's kind of what markets do. They try to get rid of a lot of the excess baggage, the dead weight, the weaker hands. They give up. But I think gold is being accumulated by sophisticated investors, by central banks. It's clear that we have a monetary crisis looming in the fiat world, and so people are accumulating gold. Central banks are accumulating gold, and we've had a few false starts. And so when gold makes a new high, I think investors are still trained to sell into it, because every time it's made a new high, it's pulled back, and the people who sold made money and they were able to buy back cheaper. But it's going to work until it stops working. And then I think that once the price of gold, breaks out, let's say we make the new high, let's say we get up to 2150 next time, and then they start to sell it, and they can't bring it down very much because new buying comes in and the price makes a new high. And, and the efforts to sell don't, produce a much lower price. That the buyers coming into the market are just taking up all that, the sales. And then at some point, it's the sellers that are going to throw in the towel. They're going to stop selling. And, when it comes to the paper markets, it's going to work both ways. A lot of people were shorting gold that didn't exist, that they didn't own through the futures market. And so that allowed selling to take place that might not have taken place without the futures market, because how do you sell what you don't own? But futures markets allow you to sell what you don't own.
As we conclude this riveting exploration with Peter Schiff, the stage is set for an extraordinary chapter in the world of finance. The anticipated surge in gold prices, driven by global inflationary concerns, unveils a compelling narrative of economic evolution. Don't miss the chance to stay ahead of the curve. Subscribe for more thought-provoking insights from Peter Schiff and other economic gurus. Your financial journey continues here, where knowledge meets foresight.